So we're going to talk a little bit about the U.S. economy and the equity markets and what we see going forward this year. So when we put together this presentation, obviously this is one of our biggest ones of the year, we started putting together an outline back in about mid to end November. And believe it or not, with the last 2 weeks and the volatility we've seen, we've had to make a lot of changes to the overall presentation. But when it comes to U.S. equities and how we see the U.S. economy, we haven't really made too many changes to this section, and I'm going to show you why. So here we have the fight continues. The bull looks a lot better than the bear does in this photograph. This we maybe could have updated a little bit to have the bull look a little, at least like he got punched in the nose maybe. But we still feel as though we still have room to run in this current bull market. So let's look at 11 of the previous economic expansion times, dating back to about the 1940s. And as you can see, the one I want you to focus on is this lower blue line. So this lower graph is the number of quarters. So we're at about 10 years since the previous market peak. If you look at the y-axis, this is the cumulative GDP growth of all these expansion times. I mean, you can see we've had the second longest time frame during this current expansion, and that leads a lot of people. We get a lot of questions. Well, we're so far into it. We're 8, we're 9 years into this bull market and this recovery. When is it going to end? But when you look at the growth that we've seen over these past 10 years, it's been really muted. We've only seen a cumulative 14% rise in GDP. That is well below what we've seen in the past and far below what some of the strongest recoveries have been. So just because we're long in this recovery cycle doesn't mean we're necessarily towards the end of the recovery cycle. Now let's talk about wages a little bit. And we talk about how that January jobs report, the wage number really is what sort of set off this current selling. But if you go back to 1965, we're in a really low, subdued wage growth environment. And really the past 8, 9 years, we've actually only kind of hovered around 2%. Past couple of years, we've seen about 2.5% growth. This past January, we did have 2.9% growth. But compared to the last 50 years or so, really subdued. And the one number I want you to focus on here is what we saw in 2008. If you can remember, starting towards the end of 2007, the economy was really declining, and it was declining fast. But if you look at 2008, which is this bar right here, wages were actually growing in 2008. And how does that happen when we're in one of the worst economic downfalls that we've ever seen? Well, I want to show you a different way to look at wage growth. So the reason being that we saw wages on the rise in 2008 is that a lot of the people that were losing jobs were lower income earners. So if you look at how the Fed calculates that wage growth, they do it by law of averages. So if lower wage earners are leaving the workforce, more of the higher wage earners are there. That actually showed an increase in wages, which at that point doesn't make a whole lot of sense. Well, this is a different way to look at it. This takes actually the median wage growth versus the average. And so when you look back in 2008, 2009, you saw a steep decline there. And when you look at this current recovery cycle over the last 8 or 9 years, you actually see it growing. And it's more in the 3.5%, close to 4% range of wages versus 2.5%. So that leads us to believe that the economy is actually a little bit stronger than what's being indicated by the Federal Reserve job growth numbers. What it also indicates is that we're seeing wage growth out there. We've had that, and it hasn't had as big of an effect on inflation like everyone thought after this previous wage growth number. The big reason why this is so much higher is actually because the number of baby boomers who are retiring, usually higher earners versus millennials and younger folks coming into the workforce who are lower income earners. So this is why this number is a lot higher, and we've seen this is probably a better indicator of how wages are actually increasing in our economy right now. This is a chart showing leading indicators, and leading indicators can be different economic data out there that can be somewhat predictive of how the economy is going to react and how it's going to look going forward. And when you look at it, this is a great chart that helps us over the last 4 recessionary periods, helps us sort of predict when those periods are going to happen. And if you go back, on average, when that leading indicator number hits the previous peak, it's been about a 6-year average until we've seen the next recession. We've just hit that previous peak last year. So we're just in this first year of hitting previous peak number. And like I said, over time, this has been a pretty good, not to use the word again, but indicator of when we're getting into a recessionary period. And when you look at this, we're just getting back to previous peak. We may still have some room to grow before we really have some recessionary factors at play. I want to get into valuations and the price of stocks because one of the biggest holdups right now from investors, if maybe they're in cash or maybe they're getting a little nervous, is that by and large over historical norms, stocks are a little overvalued, or they have been a little overvalued. And so this number right here at about 16 times forward PE, so PE ratio is price to earnings. Essentially what it means is it's giving you what you're paying for a dollar of earnings. So historically, you've paid about $1 for $16 in earnings. If you look back, right now, well, this is actually at 12/31, we were at 18.2 times forward earnings. So we were a little overvalued versus historical norms. When you look back at 2000, this is this peak right here. We're well below what the peak was in 2000, which sort of led the tech bubble and the great sell-off that we saw there. But what's really important to look at is where PE valuations were at 07 and 08. So right here, they were still underneath the historical averages. And what that tells us is that valuations, they're important when it comes to investing and picking and choosing where we want to be invested in the market. But by and large, overvaluations isn't the only indicator of when we're heading into a bear market. Just because stocks have been recently a little overvalued doesn't mean they don't have room to grow. As you can see, back in 07 and 08, it wasn't valuations that started that sell-off. It was more the U.S. economy and really the U.S. consumer and how they were a little bit over-leveraged at that point. But now if you still want to take into account where valuations are and if that's still a holdup of getting invested into the stock market, let's look at how stocks have become a little cheaper over the last couple of weeks. So two things are at play here. One, we've had the sell-off, we've had the market correction over these last 2 weeks. So this white line is the S&P 500. The orange line is where valuations have been over the past few years. As you can see, we got up, in this case, earlier in the year, a little over 19 times earnings for the price of S&P 500 stock. With the latest market decline, we're actually under 17 times. So we've seen that number come down about $2 for what you're paying for those earnings. So we've seen a decline. We're actually closer to what that historical average is. And the other reason why we're seeing this drop so much is the tax bill. And the new tax bill that's come into account is going to factor in higher earnings going forward. So let's look at earnings. So we've taken this back to the start of 2014, so over the last 3 years, and what we see, at this point, we have it going to 2017, and then what do the future earnings look like? And as you can see, we see the red here. This was back in 2015, 2016, where we had energy and gas prices tumble, really affected energy stocks, so earnings were greatly impacted at that point. But right now, we've had some tremendous earnings growth in the past year. And going forward, we're expecting about 17 to 18 times increase in earnings going forward. I mean, that's a tremendous growth rate. You don't see recessions happen when we're seeing this sort of growth in the overall economy. And again, this is going to support where stocks are valued and how they're trading. I mean, at the end of the day, when we're making investment decisions, we're always looking at the fundamentals. We always talk about how fundamentals drive stock prices and where the stock market is. Let's look at the impact of the lower corporate tax rate. So if you can see, the S&P 500 over the last year or so expected essentially earnings per share of about $34. When the new tax bill went into place, that number went up about $2, about a 7-8% increase of what the expected earnings growth going forward. So the corporate tax bill is going to have a big impact on how these companies are doing. The old rate was 35% going down to 21%. Most companies aren't paying 35 effective tax rate, but at the end of the day, this is going to have a big impact on these companies' bottom lines. And in the short term, at least, this is going to have a positive impact on where their earnings are and should help sustain a continued bull market that we're seeing right now. And lastly, let's look at the U.S. consumer. Like we said, we looked at valuations. Valuations probably had a big impact on the tech bubble back in 2000, but when you look at 2007, the market crash of 2008, valuations really didn't have that big of an impact on stocks at that point. It was really the U.S. consumer and how over-leveraged they were, and that really led to the housing collapse, which led to a recession and led to a stock sell-off. Well, right now, when you look at the U.S. consumer, we're in a much better place than we've ever been. Yes, borrowing and debts have gone up, but the economy is growing. That's naturally going to happen. But when you look on the left side, these are U.S. consumers' total assets, up in about $112 trillion. This is going back to the third quarter of last year. Overall liabilities at about $15 trillion. So there's 7 times more assets than there are liabilities on a whole, on a U.S. basis right now. So it does show the U.S. consumer is in a much better position than they were going back 10 years ago. So with everything else in place, between corporations, the new tax bill, fairly valued stocks, strong U.S. consumer, a lot of factors are in place for continued growth from this point moving forward. So why are we optimistic? Well, as we've seen, the risk of a recession right now, both U.S. and globally, and we'll talk about international stocks and the global markets a little bit more later, are in really good position. We haven't seen global growth like we saw last year in quite some time. Increased consumption, and when you think about the U.S. consumer, makes up about 70% of GDP, so they have a tremendous impact on the growth of our economy. Increased consumption supported by wage growth and strong household balance sheets will drive economic growth from here. U.S. equity markets are, as we've seen, very fairly valued. They were a little overvalued at the end of the year. With the latest downturn and expected earnings increases, they're much better valued than they've ever been in the past year or so. And lower corporate tax rates have begun to impact earnings, and we're going to see double-digit growth heading into next year. So all these factors lead us to believe that we still have room to grow in this current bull market.